How's it cheaper to own a home versus renting a home? Look at the numbers. Clearly, the mortgage payment is more than the rental payment. What's up, everybody? This is Luis. Hope you are all having a wonderful day. So in this video, we're going to do an apples to apples comparison on a monthly rent payment versus a mortgage payment. All right. Promise that it is not what you would expect. So let's jump right into it and break down these numbers. Monthly rent, you paid every month and that's it. As in, there's not really much more to it. You pay your rent at the beginning of the month and you get to live in the home for that month. Now, when you own a home, it's completely different because you get three main benefits, and that is the tax benefit, the principal pay down, and the appreciation. Let's start with the tax benefit. When you own a home, you're able to deduct your mortgage interest, your property taxes, and your hazard insurance at the very least. So to make sense of this, let's look at a very overly simplified example. Assuming you earn $200,000 a year, minus your total housing expense, except for the principal, because that's not tax deductible. So that's $50,000. We're talking about insurance, property taxes, and mortgage interest. So you deduct that from your annual income. That's $150,000. So if you don't own a home, you're going to get taxed on $200,000. If you own a home, you're going to get taxed on the $150,000. Again, this is a very simplified example. Let's look at an actual scenario from an actual client. So in this case, $900,000 is going to be the purchase price. He's putting 20% down. Interest rate is 5.5% on a 30-year fixed, and it's no secret that the rates have increased over the last few months, but it still pencils out nicely. Total payment is $5,125, and this includes a principal, interest, tax, and insurance. And right beneath this field is the tax benefit field. That's $1,115 in tax benefit for owning this home. Right beneath this tax benefit field is the principal paid field. That's $788. This is money that every month is going towards the mortgage balance to pay that down. You're not throwing away money like you would if you were renting. And when you factor these two benefits into the total payment, that is, you subtract them from the total payment. So $5,125 minus the $1,115 minus the $788, that gives you a total net monthly payment of $3,222. This person is actually paying $3,500 a month. So it is cheaper to buy than to rent. Let's say that you don't have the 20% down to make this work. So you can put 5% down, which is the first column on the left. Same interest rate, 5.5%. Your payment is a little over $6,000. But again, you take into account the tax benefit, the principal pay down, and you have a $3,965 total net pay, which is slightly higher than the $3,500. But in this case, you're buying and not renting. So let's talk about appreciation. In Santa Clara County, year-over-year appreciation has been at least 10% over the last 20 years. This means if you bought a home in 2007 for $900,000, it is now worth about $1.7 million. This is assuming at least a 10% appreciation. So let's go back to our scenario and wrap it all up. We're going to take a look at a 5-year forecast. So what is the net worth in 5 years for this buyer? So let's take a look. Net cost, if you are renting $223,000 is going to be your net cost over a 5-year period. If you're buying, your net cost is going to be under $200,000. It's going to be $188,000. Now, let's look at the property appreciation. Real estate value is going to be a little under 1.1 million using just a 4% property appreciation forecast. We just went over a historical chart where it is at minimum 10%. So I'm being extra conservative. And even then, we are looking at 1.1 million. The loan balance is going to be 665,000. So in 5 years, just 5 years, you're going to have a total equity net worth of 430,000. So you may be thinking, well, I don't have 20% to put down. I only have 5% down. Take a look at this scenario. You're looking at $304,000 in total equity. So after reviewing, you can clearly see that it is indeed cheaper to own a home than to rent. You cannot compare a rent payment versus a mortgage payment at face value. It's just simply not an accurate comparison. With rent, you simply pay to have the privilege to occupy the property. When you own a home, you're building wealth, you're taking advantage of all these tax deductions, and you're paying down your loan. So there's far more to it. So to end, when you're buying your home, don't just look at the monthly payment. Look at all these factors. And if you need help calculating all these figures, let me know. I'm here to help. Hope this helps. And if it was useful, please like and subscribe down below. Comment. Let me know what you think. I would love to hear your thoughts on all of this. All right. Bye.